Let's Talk Money.
Welcome back. Here with us on Let's Talk Money. And this week, we are discussing the contours of a brand new investment product that will very soon hit the market. It's called a new investment class. It's been launched by SEBI, and very soon you'll find mutual fund houses, AMCs, coming out with this product along with the regular plain vanilla mutual funds. So we've established, gentlemen, that the threshold is 10 lakhs, which brings me to, another issue. Someone who can invest 10 lakhs might, as I said, might have more capital at their disposal, can also invest up to 50 lakhs, which is the threshold for the next product, which is the PMS, which also has more flexibility. So, Ashish, your thoughts on how will this compare with a PMS, which also, promises to give you tailor-made advice and slightly more sophisticated risk-taking strategies, etc.?
See, there are two or three things. One is somewhere there is this belief that asset management companies and asset management regulation has been around for 35 years. Whereas in the recent times, there has been a proliferation of large number of service providers, probably running into hundreds, if I'm not wrong, even into thousands, correct? Now, if you really look at it, there's say, let's say a PMS, which says that why you should go to a PMS is because, we have only 5 or 6 stocks. We run a very concentrated portfolio, or somebody buys an investment basket saying that, I can run a PMS for 5 lakhs because you're just buying a basket of stocks and I'm curating the basket for you, right? Now, what happens is that it can come from thousands of service providers.
Yeah, I mean, and there are mutual fund houses who run their own PMS strategies. There are individuals who run their own PMSs. Yeah.
But look at it this way. Now, in this new asset class, the single stock limit is 15%, which means that I can run a 7-stock portfolio, which typically a PMS or an investment basket might offer. Right? Plus, it's a fund structure, which means that it's a proper fund structure which is not operationally as intensive as a RIA agreement or a PMS, right? Because in a PMS, you're opening demat accounts, signing up individual client agreements, trading for individual clients. Whereas here, you can run a highly concentrated equity portfolio, unlike a mutual fund.
Got it.
But on the other hand, if you see in a PMS, for example, PMSs have performance-linked fees, and you don't have to have a flat fee, you may have a performance-linked fee.
Sure.
Now, this new asset class or even mutual funds currently, they don't envisage a performance-linked.
Yeah, Ashish, so basically in mutual funds, we have these TER slabs. It has nothing to do with the performance of the fund, right? So you're saying this could be different?
Yes, because, like I said, disclaimers apply because we're awaiting the regulator to give us the final details of how new asset class will be priced. But I won't be surprised if it comes with some performance-linked fee-related innovation, etc.
Sure.
I mean, in fact, I hope it does, by the way.
But from me, the investor's point of view, couple of things that I want to know, right? One, okay, I've understood that it is probably going to take on more sophisticated strategies, hopefully come out with better returns than plain vanilla funds. First of all, do you think, that is a realistic expectation to have? Because one is okay to pay a little more than a plain fund if you're getting slightly higher returns. And obviously, then B will talk about tax efficiency, but let's answer the A first.
Right. So I think, look, it's a little more nuanced than that. It's not just about better outcomes in terms of returns. It's also about managing the risk. Because like we spoke, a mutual fund doesn't allow you to take a directional call.
Sure.
Okay. So this asset class, based on whatever details we've got right now, it can combine different asset classes. It can combine a credit. It can combine a long-short strategy.
Sure.
So it can have a much better risk-return profile.
So, again, to go back to the comparison, when right now we're only talking about the product and what can it potentially deliver in terms of the structure and the return. That flexibility is also available to PMSs. It's also available to certain categories of AIFs. So what will be the difference there?
Right. So, look, so let's come to the definition of a PMS and AIF very quickly so that, it's easy for your viewers to understand. PMS is a go-between mutual funds on one side, which is a completely pooled, managed vehicle, and direct stocks on the other side, right? So you're basically entrusting your money with a manager who's operating out of your own demat account because it's not a pooled account, right? That is point number one. Second, there are a lot of boutique managers. So the rules are a little more relaxed for PMS. So there are a lot of boutique managers who are managing money for clients. So SEBI wanted to bring them under a regulated umbrella. Right? So if you want to go to a particular manager and that manager only has a PMS license, there's no choice. You have to go through a PMS, right? AIF then becomes a more sophisticated vehicle because the minimums are 1 crore.
So 1 crore is the minimum threshold for
AIF. For PMS, it is 50 lakhs. This becomes 1 crore. There, then you start moving into the ultra HNI, family office, institutional universe. And even within that, there are different categories which allow you to do different things, right? Category 1, Category 2, Category 3. So this new vehicle, if let's say the tax advantages are very similar to mutual funds, and it does offer the kind of flexibility that we've been discussing, then there is a chance that it may cannibalize the PMS structure, because the PMS structure was invented so that you could take a little more concentrated positions, you could manage the portfolio with a little more risk as akin to a mutual fund, which is a more distributed kind of a vehicle. If this vehicle gets similar tax benefits as a mutual fund, then there is a chance it may cannibalize.
It could really trump then PMS and AIFs.
It could cannibalize a PMS as well as an AIF, but the PMS will still have its charm, because if you want a boutique manager to manage your money, and that person has only a mutual fund, I don't know how widely they'll distribute this
someone who
license.
customizes client by client, for example, that will only happen on a PMS.
Because this will still be a pooled vehicle. Remember that, right? It'll give you more flexibility, but it'll still be a pooled vehicle.
So, net, we have to obviously wait for the final rules to come through and really wait to understand what's going to be the taxation structure, because whether we like it or not, when investors do want to go in for products which can give good returns and are most tax efficient, because that's the reality of life. Tax does end up driving a lot of flows. So, gentlemen, before we come to the end of the discussion, I always ask for some executable ideas or tips or, just an understanding. And I typically like to find out where our guests are investing their own money, what is the new thing they're doing in their portfolios, if anything. Ashish, what about you? I know because you are you're running a mutual fund house, so I think there are certain rules that apply anyway. But what are you doing for your wealth?
No, we do exactly what we tell our clients. We invest in White Oak funds. So that is simple. So, I invest in, so anything that White Oak manages, I'm very clear, I invest only in White Oak. But yes, when it comes to, say, private equity, crossover, pre-IPO, of course, I am subscribed to other managers because that's where they specialize. But yeah, all in all, I'm only into equity and real estate, nothing else. And I don't call myself a disciplined investor.
That's physical real estate?
Yeah, so I don't call myself, I would say, I would classify myself as an indisciplined and aggressive investor. So I don't think people should do what I do.
That's very interesting coming from the CEO of the mutual fund. But that's candid, and I'm sure you do a lot of homework and do your own, risk assessment, which is really important. It is not a one-size-fits-all solution at all, which is where we need Ashish's advice as well, right? So, Ashish, what's your recipe looking at the environment today?
I'm glad you reiterated that, one size doesn't fit all.
Yes.
So I'm on record to say that I'm a 100% equity investor. Okay. My portfolio has only equities in it. There is no other asset class. And it's through a combination of stocks, mutual funds, AIF, and PMS. So I have all products.
And what's the house call? I remember we had Ashish on the show, I think some 6-7 years back, just ahead of Diwali. No one was talking about gold. I'll never forget that call, a pre-Diwali show. And Ashish said at least 15% of your portfolio needs to move to gold, and the rest was history. What's your asset allocation now?
So in fact, it's interesting we're discussing this right now, because this year in January, our report was titled Year of the All-Rounder. So we said we are bullish on equities, we are bullish on gold, we are bullish on fixed income.
Correct.
All three products. And that call continues.
Okay.
We continue to believe that you must have a multi-asset kind of an approach, because equities, we continue to be positive over the longer run, but near-term risks are there in the system. Gold has done very well, and we continue to be positive on gold given the kind of geopolitical situation that is developing. And fixed income, again, the expectation is that interest rates will come down. So actually, for an investor, is the best of all worlds.
Right now.
And if you want to participate in something like this, I think they have a multi-asset fund. So do other fund houses. So multi-asset is a big house call at the moment.
Right, and they've gotten a great tax advantage as well now. So that's a product category that's really picking up. Finally, no China anywhere. I keep getting asked this last 2 weeks. So many queries have come in, right? Because that's how investor psyche works. Saying, should we invest in China? How can an Indian investor take exposure to China? Ashish?
Yeah, so that's a great point of discussion. I think the fact that China has rallied so much has suddenly, there are a lot of interest which is coming from investors. I generally believe from a policy point of view, still all is not hunky-dory. I mean, you've seen the flip-flops that the government has done on the policy front. Yesterday, it was down 7-8%. So at best, given where valuations are, it could be a trade. But I wouldn't risk to say that, it's an asset class that people should go and allocate to. And do it only if you understand that market. Because I mean, first, getting an understanding of different sectors and markets in India itself is tough. Talk about,
People want to do the exotic, right? That's why even the regulators acknowledging that and launching a new asset class. But gentlemen, thank you very much. Very, very helpful conversation. Thanks for being here, and hopefully you will keep joining in so that we understand this new product along the way as more clarity emerges. But thanks for the conversation today.
Thanks a lot.
All right, with that, it's a wrap on this edition of Let's Talk Money. Do remember to keep following us and keep sending us your thoughts, comments, queries on the show. And of course, keep sending us ideas. Anything new you want to know more about in the world of money, we're right here. See you again next week.
Let's Talk Money